Hey guys, today we're looking at amortization on a profit and loss statement, how it all works and how it flows through the different statements. So let's imagine we've got a particular idea, or we've bought some intellectual property. Now the thing about amortization, it's for something you can't touch. It's an intangible asset, but yet it is involved within the business. So maybe it's someone's intellectual property that we buy. So what happens? Let's say, in this instance, we buy some intellectual property for $200,000, all right? And for instance, what that would look like in terms of how it flows. Now, it won't go on your P&L until we do the amortization part. Now, watch closely. What will happen is, let's say we've got $500,000 in cash, and we've bought this $200,000 in an amortization intangible asset. So what's going to happen is we've got 500 minus 200,000. So our asset base amortization will show now 200,000, and because it cost us 200,000, we'll now only have $300,000 in cash. Now, profit and loss, when it comes time for the accountant to do their magic on the figures and reduce our tax. Now, tax is a good thing. We've all got to pay tax, but do it legally when you reduce your tax. Here's how it will flow. So in this instance, we've got a business that has an income of 500,000, cost of goods 300, so a profit of 500 minus 300 is 200,000, and our fixed expenses are 100,000, and so our profit is now 100,000. So we've got 200 minus 100 gives us 100,000. Now, if we're paying tax at 30 cents in the dollar on the profit, and it's different in every country, you'd need to talk to your accountant about this, is 30% of 100,000, you're gonna pay 30 grand in tax, okay? Now watch this. Let's say with our particular intangible asset that we've got 200,000, let's say we're gonna write it off in value at $50,000 a year over 4 years. And each country has a different way of allowing this to happen. Here's how it plays out. So it comes down here, looks on your P&L like this. So we now have, most of this will stay the same. Our P&L is 500,000. Our cost of goods or our cost of sales is 300,000. Sorry, income's 500. So we have 200,000 of gross profit. Here's where you're adding your amortization. So we're gonna amortize it at 50 grand. Now, notice this is a lot like depreciation. So we're gonna amortize it at 50,000 over 4 years until that goes to zero value. Here's how it looks. So now 50,000 comes off your balance sheet, jumps onto your fixed expenses like this. It's not an actual thing you can buy. It's a taxation, bit of a magic thing. So now we've got 200,000 minus 150 means that we have 50,000 profit. So let's say the tax scale drops down to 20% when your profit is below 60,000. So now we pay 20% of 50,000 is 1/5, which is 10,000. So using this particular amortization and writing it off through your P&L, you've saved yourself $20,000 in tax. So hopefully that helps you understand what amortization is and how it applies to financial statements. Just quickly, by the way, it has no influence on cash statement. Okay, cash is actual cash movement. This is theoretical cash movement. So have any questions, comment down below. I can make some more videos to help you understand.